Hi, welcome to Bond Bytes, the daily bond market highlights from INR bonds. I am Arjun Patsati. And with the union budget being presented to the parliament today by the finance minister, the only thing that is hitting the bond market is supply. There's supply, and more supply. And the bond yields are reacting to that kind of supply in an inflationary environment. And when there is global inflation, and the biggest central bank in the world, the U.S. Federal Reserve, is starting to hike rates in March, and will be hiking rates and tightening policy, given that inflation in the U.S. is trending at over 7% levels, the highest in or over 4 decades. This kind of worries on inflation globally, and this will also filter into India as the inflation is fed by wage push inflation in the global markets, as well as the fact that there is a lot of price pressures across goods and services in the global markets, and this is coming down to India. And with this, if the even if the RBI starts to support the government borrowing, it will add more and more money into the system, and this will be highly inflationary in nature. And and with high inflation and heavy supply, then the only thing that can happen is bond yields can go up. So we are expecting the government has shown in the budget that there will be at least close to over 14 trillion of gross borrowing. Gross is borrowing is including bond. The government will have to fund bond maturities, and the net borrowing, which is the fiscal deficit, financing the fiscal deficit, is around 11 trillion. And the states too, the government has given states a leeway to borrow up to 4% of the gross state fiscal deficit and take up to 4% of gross state fiscal deficit. And even if the states, this comes to around closer to rupees 10 trillion. It could be including net and gross and net. And so you have the heavy supply of states as well, and a heavy supply of government bonds. And all this is going to take up inflation, is going to take up the fact, is going to worry the bond markets as how will they absorb the supply. And the RBI, like I said, will have to do a very difficult act of managing bonds and that's borrowing and inflation. And the government will have to think of many other ways to make sure that the supply in the market is much is reduced. Else the government bond GSEC yield will trend very high. Even at this point of time, we do see the yields trending to the lower 7% levels, and so that's going to take up interest rates in the whole economy and push up borrowing costs for corporates, etc. And with even the budget itself seems to be a borrow and spend budget by the government, and typically a borrow and spend budget is highly inflationary in nature, even though the government has given a 35% increase in capex, that is capital expenditure, which will go to create capacities that will in the future will bring down price of goods and services. But as they create capacities, they will spend, and that will take up inflation. So all this doesn't look good for the GSEC market, and obviously INR bonds is the best place to come to for understanding where to invest and what to do in the bond markets. And download Quick Invest by INR Bonds, Quick Invest app by INR Bonds, the app on iOS and Android, to find the best bonds to invest in to ride over this rising interest rate phenomenon as there is more and more supply of bonds coming in. And the download links are given in the description below. And please do press the like buttons as well um, as subscribe to our channel if you have not done so. And we welcome your comments as well. Thank you very much.